Okay, if you start searching harmonic patterns, you're going to see all sorts of stuff on the internet. Okay, lots and lots of stuff. Right, everybody's an expert at harmonic trading. All right, and there's some very, very good traders out there, and a lot of them, basically, including myself, have emulated guys who have come before us. All right, and these people who, if you and I've researched everything out there. So the people that you see on the YouTubes and stuff, some of these companies, they don't get it in terms of the risk. They don't get it in terms of the patterns themselves and the market geometry. So we're going to go into that a little bit today, and I'm going to show you some things. Dating back, you have Bryce Gilmore, you have Scott Carney, you have Larry Presavento, you have a couple of other people in the industry. Jim Keen is another guy who's really big with harmonics. And you have Larry Presavento. Let's see if we can look up his name. Larry Presavento. Okay, so this is Larry Presavento, and he was one of the originators in the harmonic world. He did a lot of work with a guy whose name was Bryce Gilmore. Bryce Gilmore is retired now, but he's from Australia. Yes, Trish, he's from Australia, from your zone, and he was an S&P trader, and he wrote a lot of books on market geometry, on ratios, a lot of information. I mean, this guy has written books after books, Market Geometry 1, Dynamic Markets, and in his books, he did a lot with market geometry, which is basically taking the Fibonacci, or what we call phi, PHI, and breaking it down. He's taking squares and circles and breaking them down in such a way that it's understandable. So phi, PHI, is the world's most perfect number, 1618. And then 618 is the inverse to that. So if you were to start breaking it down or scaling it up, you can look at 1618 plus 1 is 2618. Divided by itself by 1, or 1 divided by itself is 0.382. 382 squared is 618, squared is 786, squared is 886, and you got the inverses of those, which is 113, 1618, and so on and so forth. Now, if you go on IMarketsLive website on the back office, all right, we have a class I did on commonalities. So I'm not going to do all that again. So the class is there on commonality patterns. So that goes into all the breakdowns of phi and all that stuff, where you have, from that point, you're taking the square, you're dividing it up, and you're getting these other ratios, which is 707, 141, which is the inverse diagonal of a square. So we have all these numbers, and they all work together in terms of market geometry. And Bryce Gilmore, the original pattern was called the Gartley. Let me see if I could show you Google Gartley. I have it, but what I'm doing is we're showing this up on a VPS. So um, I'm recording it on my computer, but it's actually the work is being done on a VPS, so I'm recording over it. So the Gartley pattern, as you see here, everybody's a Gartley expert, but nobody is an expert. Nobody's an expert. Not me, nobody. It's just basically you're identifying these patterns. So let me look for Gartley's original pattern. It was in the book, and I just saw it. Okay. Profits in the stock market, it's called. And I'm sure we could find it here if I want to do a search, right? Guess not. Gartley. That's the book there on the top. Here it is. All right. This is the original diagram that was put into a book many, many decades ago from H.M. Gartley, and it was on page 222, and it became known as the Gartley 222, or the Gartley pattern. TK is asking a question. TK, I'm not even going to get into that yet. I'm trying to educate you on what everything is about first, okay? So the Gartley pattern, was the original pattern that came into play. And if you see here, the way he drew this pattern, it ended up being considered somebody took it and started developing ratios, which you have Larry Presavento, you have Bryce Gilmore, you have the pioneers of the industry that went ahead and did this. Now, Larry Presavento, I would say, was the guy, all right? He was the guy that got all this started here. Now, I'm sure you had other people, but let's just say Larry, because Larry was the man is the man in the industry in terms of these patterns. Now, from that point, he worked with Bryce Gilmore and came up with other patterns called the butterfly, and then Scott Carney came in and called them the crab and this and the shark and all this stuff. So we'll get to that. But this is the original diagram that was in the book. And from that, somebody came up with ratios. They didn't have this. There was no ratios at the time. So it's not like somebody came in and I came in and got smart about it. It's basically I'm taking what was put forth before us. This right here is what became known as the Gartley pattern, where you have an X, A, B, C, D. I'm going to switch now and go to the Harmonic Trader site. So just give a little early education. And since we have everything up on the VPS, it's easier for me to do this. Okay, so the Gartley pattern, again, it was originally discovered outlined by H.M. Gartley in his book, and then later on in life, other traders came in, and I would venture to say it was Larry Presavento because he was the original guy who got all this stuff started. And then, like I said, with Bryce Gilmore, and we'll discuss that in a minute. So the strict criteria that was put together was your X, your A, your B, your C, and then your D. And within this structure, they have the criteria. So X is your low, A is your high, down to B. B is your first retracement area. So you see this? And that's a 618% of the X to A rally. So from X low to A high down to B, it has to be around 618. Could be a little bit shorter, but really not to exceed that. You know, these numbers, although they're strict, I like to just have a little bit of flexibility about them. And so does Scott Carney. You know, he talks about it also. And this is Scott's site. So from your A to B, you had a sell-off. Well, from B to C, the market can retrace 38% or as high as 88%, 88.6%. All right. So that gives you your C point. And then from there, your D point is a couple of things here. It's number one, it's your B to C extension down to D. And what that means, let's just say B to C was 10 points. Well, from C to D, based on the 127 and 161 extensions ratios, B to C is 10. That means going from C to D would be what? 12 to 16 points, you see? And then the other criteria, and this is the main criteria I'd like to watch, is that X low, A high down to D. and that's a 786 retracement. All right, so you have within the structure these ratios that all work together. When these ratios all line up, then you have a pattern. Now, if you're in a very weak bear market and you're buying, it's a bit tougher. If you're in a trending up market, you're more likely to have a pattern set up for you. Now, I know Hawkeye is with us, and over the years, when we with Linda Rashke, over the many years, she did a lot of work, what we called the three pushes. All right, the three pushes were originated from the three drives, which you have Larry Presavento and these other guys. Okay, they all came up with the three drive and the three pushes, the three Indians. Okay, in her book Street Smarts. Originally, what is that based on? Is based on Elliott wave. The Elliott wave has a 5-wave sequence where you have a 1, 2, 3, 4, 5, which essentially the 1, 3, and 5 legs are the three pushes. So let's see if we can do a little searches here. So if we do a little bit on the images and we look at the 5-wave, let's just pick it up here. What we had called the three pushes was essentially the 5-wave. You see that? Three symmetrical drives. Larry Presavento and Scott Carney and Bryce Gilmore, they all called it three drives. Linda called it three pushes, three Indians, and the Elliott wave people call it a 5-wave. It's all the same thing, essentially. All right, and there's waves within waves. So getting back to that, this would be considered that wave when then you have that ABC correction. So in an Elliott format, you see this ABC correction. You have your fifth wave, then your ABC down. But in harmonic world, this would be your X, the 4 would be the X, the 5 would be your A, the A would be B, B would be C, and then C would be D. And if you look here from 4 over to C, that's actually a Gartley pattern. You see that? That structure right there in an Elliott wave format and stuff that we were doing in the past, Hawkeye, believe it or not, was harmonic type of work because you're looking at the 4 to 5 swing and then you're getting that corrective wave down, and that corrective wave down essentially is your Gartley pattern or a bat pattern. The bat pattern is similar to the Gartley in the respect that the initial pullback is very shallow. So the Gartley went to 618 and the bat, okay, I see a question, just hold on, TK. The bat comes 38 to 50% down, up the same ratio, and then down, but that X low, A high, D is an 886. That's your main thing. So Gartley is a 786 with a deeper A to B. All right, but regardless, you can call this a bat or a Gartley in this the fifth wave and the ABC correction of an Elliott. Now, I want to make clear that even if you're going from 0 to 1 or 2 to 3 or from 4 to 5, within that you're going to have minor waves. So if you look here at some other people's stuff, we just use other people's stuff. They don't even realize it. All right, they did the work for us. So if we look here within the structure of a wave anyway, you could see that these little Gartleyan bats along the way, where we call them ABC corrective waves, it's also in the harmonic community considered an XABCD, XABCD, you see? So looking at the harmonics, they define the ratios. Now what Bryce Gilmore did, and I follow his work more than anybody else, is because we're taking the geometry of the market, not just these strict ratios, but we're taking other ratios from swing lows to swing highs. So I have a question. I'm going to pause the video. Well, just ask you a question. This is a live class. Okay, TK, what's the question? Okay, isn't it Gartley only when continuing up on your Elliott chart, we know only afterwards? Okay, so let's go here. See, a lot of people think when you're looking at Elliott wave that it looks great after the fact, right? Okay, so let's take a look at, let's take a look here. I think I have the USDJPY. Okay, we did a early class this morning when we first logged in this morning. All right, so let's go here and take a look at this. This is considered a shark pattern, but it's all a derivative of the Gartley. It's all based on the Gartley. It's all based on Elliott, however you want to look at it. You're always looking for the D point. All right, you're always looking for the D point. Okay, so right, I don't know what happened to that chart. I have to be honest with you. Oh, here it goes. Okay, so let's take the market as we see here. All right, you guys see this, right? And we talked about how we exited up there. So let's just take a look right at this. You can see that there's a small harmonic type of pattern where you have your low, which is your X, your A, your B, your C, and your D. Now, the D was a little bit shallow. For this to be a real harmonic, either what they call a cipher or a shark, everybody has their own names. The shark is basically 886 to 113. Somebody came and said, okay, look, we'll call it the cipher because it's 786, but it's all relatively the same. So we'll go with Scott's stuff. That would have been a completed pattern. It wasn't. So you're saying that looking at Elliott and looking at Gartley, you can see the stuff after the fact. I'm saying that you're always looking for D as what they call a completion point to enter. So let's erase this stuff because I know your question, then we're going to come back to it. We're going to go back to what we were looking at. So I have no idea how the charts got a little bit disheveled here, but all right. Let me just check my data series. Okay, in this particular pattern, all right, we're digressing a little bit, but we're going to come back to it, okay? Because I know, TK, I know what you're saying, and you're a bit ahead of the crowd. So we're looking at this and saying from X to A down, okay, 113. We're always looking for D. Okay, you're always looking for D. For instance, we know the zone and we're always looking for D. You're always looking for this. You don't know that's going to be a pattern. For instance, and I'm kind of glad this chart is like this. You have your initial X, A, B, and then you have your C and then D. When the market's up here, I don't really care about this. I know a lot of people are drawing these patterns out in advance, and I do the same thing, but I'm not really serious about it. Because if the market's up here, I'm not thinking it's coming down there, because if I think it can come down there, I should be shorting them, right? But I'm not. I can care less. All I'm worried about is when it hits the D point at a minimum or a maximum. Okay, so it hits here or drives down here. So your zone is here. All I care about is that all the ratios work together, and when they do hit the zone, then that's considered a completion point. that the patterns have completed. Now, I know that Scott has done work and other people do work that if it breaks this line, you go short down to here. Honestly, I don't like that. I'd rather look that this is in a market that's in a bullish market, or a market that we can find a very good, it's very, very stretched out. I like that. So I look at this zone that when the market does get here, then we start taking it serious. So you have your X, A, B, C, D, and then it goes up. So you're saying that looking at Gartley or looking at Elliott, we know only afterwards. No, you know as it's setting up. Now, in terms of Elliott wave, I'll get to that. Okay, I'll get to the 5 wave. I'll get to all that. Not a problem. All right. So we'll get to that in a little bit. If we don't get it today, we'll get it. We'll do it tomorrow. It's not a big deal. We don't have to do everything in one shot. So I like okay, back to here. So the ABCD wave in Elliott is basically, like I said, it turns out to be a harmonic pattern, whether we like it or not. Going back to harmonic trader, there's different patterns that we look at, and it all starts with the A to B, C to D relationship. All starts with that. That's the basis of every pattern, is your A to B, C to D relationship, and there's an X point, and the A to B, C to D has different ratios. So let's take a look at the Gartley one more time. The Gartley basically is your X and then has A, B, C, D. You have one particular zone to enter. Then you have your bat pattern, which is a derivative of this. All right. So the bat pattern was discovered by Scott Carney because he basically lowered the B to A and lowered this X to D and called it a bat. Okay, it all started around the Gartley. Then you have the butterfly, which is a very, very powerful pattern. And the butterfly was discovered by Bryce Gilmore and Larry Presavento. They were hanging out one day, and Bryce said to him, "Look, check this out." That's exactly what happened. All right, and I guess everybody else all of a sudden was a butterfly guy. So the butterfly works where you have your X as a low, A as a high, B is your 786, C is your 886, 382 to 886, and then your C to D and your X to A. So you got your C to D leg and your X to A, 127 to 1618. The actual number here is a 127 extension. All right, Bryce Scott had changed it. There was some changes original, and it was this had a little bit of an error on it. So let me see if I could find harmonic. Was it 114? Let me look. Here it is. Okay, that is your butterfly pattern. Okay, the butterfly pattern, your stop goes above the 141 extension. But originally, when he made this right here, he made an error in this. But it can go from, if you're taking all the ratios together, this can extend a 1618, but that's a really deep pattern. When you're looking at that, you end up looking at these other ones, which you have the crab and deep crab. I'm going to show you this in a minute. Here's your crab pattern. You see, if you look at the ratios here, that goes as far as a 1618 on your XA down to D. And then I'll go through the deep crab real quick. And you can see if we took this and was a 127, it'd be around the same as a butterfly. So they extended this down to the 1618. Then you have the shark pattern, which I do a lot with. I love the shark pattern. This is actually my favorite pattern. All right, this pattern right here is essentially, and I'll go through that with you in a moment, is essentially this, okay? This is your shark pattern. So looking at the harmonic patterns, it all has to be, as Bryce said, with market geometry, and you want everything to start lining up. All right, let me just try to remove all this stuff. Actually, let's take a look at the Russell, and let's take a look at a daily Russell. Okay. So you're looking at Elliott wave, TK. You're looking at Elliott wave, and we could look at it in respect of all these different waves that go up. Okay. Now Elliott says, okay, in the Elliott wave theory, it says you have your 0 point, then you have your rally, and then your retracement. All right. Your rally and then your retracement. Then your next rally up, okay, and then your retracement, and then your rally up. This right here, although this has a retracement, this is not considered part of the Elliott wave for the fact that it was not longer than this first leg, and it came below this. So where the average person would consider that a wave, it's not a wave. So you're actually skipping past that and you go into the next one. Now, what Elliott wave also said was you will have one leg that's sharp. You can see this is sharp, and then one that has a complex. Oops, I'm sorry about that. One that has a complex. If I could find my line, where's my line? A complex wave down, and then goes up to your fifth. A lot of times you'll get your fifth is going to look like this. It'll look just like that. That's actually, a lot of times you'll see that. So if we look at Elliott wave and we go through the counting process, okay, let's go through the counting process, and we're going to finish it off today with the counting process and then building out one pattern from here. So in Elliott, and then tomorrow we could do more. Elliott wave, you have your 0 is your low because that's the low. All right. You have your 1. You have your 2. So it's all about structure, right? It's all about structure. If we look at this and we just change it up a little bit, it's all about structure. So in one respect, the harmonic guy is looking at this as a harmonic pattern, and the Elliott guy is looking at this as its first wave down. You see that? The next move up right here, this 2 to 3, this is significant because in Elliott wave, okay, and I'm going to bring it down to 4. In Elliott wave, your 2 to 3 leg is the largest leg. And most traders miss this first leg and try to get this 3 to 4 and try to identify where the fourth part is so they can get it for this move up. Most traders don't get it that if they are not within the structure, if they don't know where they are in the structure, they could be buying here and expecting this to go to the moon when the fact is it's ending that fifth wave, right? It's ending the fifth wave, and they're looking for, and they get the pullback and they're looking for much bigger move up. Most traders think that because they're buying here, that they're buying down here at the beginning. They're buying at the end of the end. All right, they're buying at the end of the end. So the one benefit a harmonic trader has over an Elliott trader or even a price trader where you're looking for that higher low, you just can't find it, is that you're looking at these strict ratios and these patterns, the market geometry, you're looking for patterns to get you in, and it gives you structure. So if you understand Elliott, you know where in the structure you are. You know that up here, even if you make a new high, you're expecting a deeper retracement, all right? From the 5 down, you're expecting a deeper retracement. This actually ends up being the 5. Let me just change this. This actually ended up being the 5th wave, all right? That actually ended up being the 5th. This became, and I'll get to that next. So the point was the first 1 to 2 is typically sharp. The 3 to 4 wave, either 1 to 2 or 3 to 4 is going to be sharp, and the other ones are going to be complex. Complex meaning getting your ABC corrective wave. All right, so let's you're either going to get your sharp retracement on 1 to 2 or complex. If you get a complex, this is a complex, or it's going to switch. So in this case, you have a complex corrective wave. So let's just say you're here, TK, the market's running up and it's retracing. You have to look back at the structure and determine where you are in the structure of the overall trend. You have to look and say, okay, we're getting a pullback, and this is the 3 to 4 wave. We're getting that correction here, and you have to start mapping out your retracement levels, right? You can do it from here first, right? This is your first one. Typically, you like to see 38 to 50%. All right, so we're going to put some dots here. We'll put some dots there. We'll get rid of all this other stuff. All right, so that number one will give you your immediate zone to watch. You always want to look at your 38 to 50% from your 2 to 3. You always want to do that. In your 2 to 3 leg, your retracement from 3 to 4, you're always looking at 38 to 50%, and the fact it should not cross back below your number one. So number one becomes your make or break zone. It should not go below that. So if you're taking a trade in here on a pullback, your risk can be down here, because we know that if it in Elliott world, if it fails the number one, you have a failure of the pattern. It should not go deeper. That's why this was not considered a 3 to 4. This is the 3 to 4. Then you start looking at your patterns within the structure, and you have to look at these prior swings because they are important right here. Okay, so let's take this swing here and let's change the color. I want a different color. I want a pretty color. Okay. So let's look and see where we are. So we look and we can see the 618. All right, looks like a 618 was important. 786. And we'll just do some dashes, okay? Gives us an idea where we are in the structure. Okay, so now you're looking at that. You actually could look at this swing low here as another level to watch. So this swing low is here. That's important. You're always looking at price structure, swing lows, swing highs. So when looking at the market, you're looking at these patterns to form your A to B, C to D relationships, or your corrective A, B, C down. So what we have is your 3, A, B, C. In the harmonic world, it's X, A, B, C, D, regardless. You know going into it that you're 38 to 50% from 2 to 3. You know that you have your little complex corrective wave, gives you a little retracement zone. You know you have your prior swing lows to identify your prior swing. You see, TK, how we're putting all this together so that way you're identifying turning points and you're identifying your risk. Okay, that's what you're doing. You're always identifying your patterns, you're always identifying your risk. In this case, right, your risk is right above, right at, it should not break this point. So you bring your risk down below here. All right. You bring your risk down below. Okay. Okay. Sorry, people are calling on the phone here. Then you have your next pattern up. So now we're going to go to the next pattern. Okay. So if we look at this, and we look at this in the form of a possible quote unquote shark pattern, we're going to try to make this a little bit cleaner now. So here's your fourth to fifth wave up and then down. We know because the trend is going up. We know because the trend is going up, at some point you're going to have support. It's our job to discover where support is going to be. So let's do this. Let's get rid of all this stuff that we drew, and you can go back. I'm recording this video so you can go back and look at it again. And yes, everybody's going to get a copy. So we have a couple of things. You're going to say to yourself, okay, what point do we pull our 0 point from? Where's your high? Where's your low? All right, let's do one thing at a time. What are we seeing here? We see that, and let me draw this out one more time so we have it cleaned. All right, we have our 5, 4, 3, 2, 1, 0. That's the Elliott. And then we're looking at, you're looking at your A, B, C corrective wave. So now we're looking at the process. Right here is a perfect Elliott picture where you have your 1, 2, 3, 4, 5, A, B, C back up. That's a normal environment. People thinking because you're coming so deep, well, it can never go back up here again. Well, you're in the context of an uptrend, and you just had a corrective wave. So you're in the context of an uptrend. So if we take the first things first, we're taking these retracement levels. All right. From X to A. Okay, I got to fix this. All right, we're going to get rid of this. And this is where the game comes in, TK. I know you were asking, is you have to identify where at the time where these supports come in. That's what you're looking for. You're looking at only where do these turning points come in. All right, let me get rid of this and this. And where you are in terms of the structure of the overall market. All right, so that's 1. Then we're taking this swing low here to this swing high. All right, and we're going to paint a different color here. All right, and we're going to get rid of all this. All right, and your 100% dash dash. All right, so you're looking at, and let me fix this right here. I'm sorry about that. 786. Oops. All right, so we're tying all this in together. We're starting to develop ratios. This other one right here, I like to look at the 1272, 1272 also. Okay, so what we're doing is we're drawing out these ratios. I'm also going to draw another one in from this loaded this high. But on this particular pattern, what we're looking at is the shark pattern. You're looking at this. You're looking at this. You're looking at here to here. Okay, you're looking at from here to here. That's the zone that you're looking at in terms of entering. Your risk goes below it goes to about 130%, all right? It goes a lot lower. So if you look at some of the stuff we're doing now, our risk is a lot lower. You want to allow the market pattern to have noise because you're understanding the structure of the higher time frame. So a couple of things come into play. The market has some commonality here. Now we're going to start doing these retracements. So from B to C in our harmonic world, all right, let's just see if we have a, okay, in our harmonic world, we're going to see that the 200 and 224, so you guys know, the 162, the 200, and the 224 are important in the harmonic for the shark, all right? Those are important. Now, just because we have that number here doesn't mean it's going to hit there. So we look at where things start to tie in together. If you could start really seeing right here, you have multiple areas of commonality. You see that? Multiple areas of commonality. And what's that telling you? We're starting to find a support area. So when you're looking at this, all these other lines become a bit meaningless. Your first zone is here, all right? First zone is there. You have some commonality. Here's another zone. So when you're starting to look at this in terms of Elliott, you're starting to look at in terms of harmonics and the market geometry, what do you have? Yeah, Elliott has your high, your A, B, C down, which we also take this swing, right? This swing up, and then we look at it on the way down in terms of how far it can go. So see that? If you take your first drive down to the low right here, if we take that and we bring it down and we just make some adjustments here, we get rid of all this stuff right here. What I like to do is look at the 100% 113. Okay, and I'll leave them solid. So this is where Bryce Gilmore brought his market geometry to the forefront. And then you have all these other characters put their harmonics together. I look at market geometry because I'm determining what specific area is good to trade in. I'm overlaying and overlaying, and all of a sudden you're starting to see everything start to line up. Bryce basically took every point and put ratios to it, and where they all lined up, then it started to make sense. The harmonic people came in, the Larry Presentos and Scott Carneys and all these other characters out there, put their harmonic ratios to it, but they don't allow for all this other market geometry. So I like to tie in Elliott wave. I like to tie in commonality zones from different points and ratios. And I like to take into consideration the pattern. So now you're identifying a solid zone to watch for and a defined risk point to use. All right, if you do any searches on harmonic patterns, you're going to find most people don't know about the risk point. We'll get into all this going forward, but typically you want to go past the next ratio. So in this case, 100% would be the ratio. 113 would be the ratio. I would go to a 1272 or something like that, you see. So you're looking at this. This is how we identifying these turning points, and you're getting these sharp moves out of them. So when you're looking at Elliott wave, you have to determine what part of the structure are you in. When you're doing your harmonics, you have to not only take in consideration the pretty pattern, but you're looking at market geometry also. However, the stuff that we have for the auto trader is based purely on the harmonic ratios, because to do all this other stuff, that's a whole nother programming code. All right, so that's where we stand on everything. I got about 4 minutes for questions, and then I got to get back to the programmer. Does anybody have a question or two that we can get through? Or did I pretty much make everything clear? Now, I recorded this, and you're going to get a copy as soon as this uploads. So you can go through everything again. But is any questions? There's only a couple of us here. It's a small room, which is great. So it allows us to have that intimate education on this class. Okay, somebody says, what time frame should one watch the Elliott and the patterns? It does not matter. It doesn't matter. You have to have a higher time frame and a lower time frame. For instance, if your lower time frame is 5 minutes, then your higher time frame is 15 minutes. If your higher time frame is 60 minutes, then use a 15-minute. If your higher time frame is a 4-hour, then use an hour for a lower time frame. You follow? So you always have that higher, lower. Now, if you have a higher time frame, where we looked this morning, I'm going to put the recording in the back. I'm actually going to put the link here in the room, and I'll put it in the back office. But like this morning, we had the 1 hour chart. Last night, we had the 1 hour chart of the USD/JPY. But we had a 5-minute USD/JPY trade, and that was that trade we took 25 pips out of this morning, right? Now, I went back in and re-entered with 2 individual positions for the hourly chart. Why? Because the daily chart is in an uptrend. So now that 4-hour chart or 1 hour chart has to finish consolidating and continue its trend up. So right now we're in positions for a swing trade. But this morning, the hourly trade was on support. The 5-minute trade pattern formed, and we traded it. Let me see if I can show you that. Now I get back to my regularly programmed schedule here. Okay, we see that the daily chart has been moving up. It's getting its correction. We all agree on that, right? We all agree that this being an hourly chart, all right, this formed. Let's look at this in the JP in the JY. So it's inverse, okay? All right, so we agree that the pattern has formed on the hourly chart as a buy. A sell. All right, let me just fix my other chart so I'm looking at the same thing. All right, let me just make sure we're looking at the same thing. All right, this makes it a little bit tougher for me. So let me just fix this again. believe it or not, when you go from, here it is. Let's just go back here. Okay. All right, so you had your pattern today, which was your shark that we discussed, and that's that hourly chart. All right, I'm not going to be able to get this because I don't have it's not connected properly. So, hold on a second, gang. Hold on. Okay, we got it. Okay, so the shark pattern. This is the USD JPY. Okay, this is the one we were looking at today for a trade. This is the one we're in right now, the shark. Okay, we're in this for a trade. This morning, the market gave us a smaller trade on the 5-minute chart. And let me look at that pattern so I got it straightened out for you guys. Okay, and what that was this. We took this here. We still have the overall structure, so it's okay. We took that. So TK, I know you guys had a question in terms of higher time frame, lower time frame, what time frame to use. So let's go back to the hourly chart one more time. Okay, so you're working with me. You see the hourly chart has the big pattern. Then we break it down to the smaller time frame. So you ask what time frame to use. Well, as you saw this morning on the signals, is we had the higher time frame, which is giving us support I don't want to be short down here. I want to buy. And we had the smaller time frame come in and give us a trade, and we took that move right here for about 25 pips or whatever it was. It was right in here. We took it for 20, 25 pips, something like that. Anyway, regardless, right now we're still in the mode of being on the higher time frame chart, so we are long the market on 20% of a position, because it could still come down. This could still come all the way down here and still be valid. So we took a little percentage up here. If it comes down, I'll add. If it comes down, I'll add. So we're still within the confines of 100% position. But now let's look at the Elliott wave and call it a day here. So, oops. So if we look at this as your 5, where was your 4? Okay, your 4, your 3, your 2, 4, 3, 1, 0. So this could be a 0 point, which is that lower high, okay, or this right here can be a 0, a 1, a 2, right? And this could be 3. So what are we looking for in regards to the market now is the minor swing gave us that little 5 wave down, which I did it backwards. All right, just work with me here. Gave you a little 5 wave down, but your bigger pattern is 0 to 1, 1 to 2, 2 to 3, and now we're looking to get some kind of a correction back up and then down again. So we are looking for a correction up. We have the larger time frame. Now, if we were to shrink this up, watch this. We're in the context of a higher time frame trend. You see this? This is a strong trend up. This can come all the way back up here maybe. We don't know yet. All we know is this was the last swing up. All right, so in my eyes, we have our correction down. We have our X, A, B, C, D. That's all I'm caring about. And we have a trade on, and I'm looking for it to get up here. That's all I'm worried about for now. One swing at a time. And we can see the market is starting to move again in our favor. Levels we want to see it get above. Here. Here. These are all structural points in the market that we want to get above. All right. So you have your small time frame and your big time frame. That's why you say, what time frame do we use? You always look at the high time frame, and then the small time frame, you're going in this direction of that high time frame. And that's about all I have. We went for a solid hour, rock and roll. I'm going to take a break, and the markets look like they've been doing absolutely nothing. All right, catch you in a bit.